So your first 90 days, if you're not doing this, and like I said, I'm going to put this in a nice guide for you. You should be signing up for Crexy.com. There's a lot of websites that'll show you commercial properties. There's LoopNet, right? I would say out of all of them right now, Crexy.com is the best. It's free, just like an MLS. You'd sign up, put in your parameters for types of properties and areas and things you're looking in, and it's going to start sending you deals. Okay, you're just starting to see some flow, see some opportunities. That's what you're trying to get your arms around. Start getting into the process of how it's going to work. So you're going to start there, because that's also going to give you access to all the commercial brokers. And I was mentioning to some of you, I said, go on this website, sign up, get all the stuff. When you start seeing deals, find out who those brokers are. Look down and you see who the real estate commercial broker is. Make note of it. Start putting them in your database. Now you need to kind of pick out a couple of these properties to start going to tour, right? So we said when we get down here, simulation, we're going to simulate underwriting, doing research in the marketplace, touring the properties, and making fake offers. You're going to fake tour, you're going to fake offer, you're going to fake research, and you're going to fake underwrite. I want you to simulate it, because that's how you're going to get into the motion of this, okay? But Crexy.com is going to be the start, because that's going to give you access to the brokers. It's going to give you access to property and deal flow from day one right now, okay? You need to finish all your coursework, go through all the different modules, watch all the videos, get all the downloads, put them into folders and organize them so you have everything right there for yourself. You need to start to network. You know, we talked about some conferences last week. We have a flyer going up, I think tomorrow, that's going to put in place a handful of the conferences that maybe you should start looking in. But I'd go on Meetup, honestly. Go down to meetup.com, search for multifamily meetups in your area, and go to a couple of them. Plan them ahead and go to a couple of them and see which ones you like. Some are good, some are bad, but you know, go to the ones in your area specifically that are multifamily and investor related, and start making connections. Start talking to people. Let them know what you're doing, why you're doing it. I mean, it's all about networking and connections. You have to start this process, because people know people who know people, right? And when you go into it with this mindset. Don't ask, give. Don't ask, give, right? I mean, go into it saying, hey, John, tell me about you. Oh, awesome. I can help out with that. I have this other person. I can give to that. I can help out with that. I can help you with this. And then in return, they're going to say, well, how can, if they're a real person, like a good person, they're going to say, well, how can I help you? Oh, I'm looking to do this, this, and this. Now, all of a sudden, you're depositing into each other's relationship accounts. That's how it works. And then we're going to simulate. That's where you get, if you have the downloads, we're going to simulate the underwriting and going through some of these deals you're going to find here. You're then going to turn around and you're going to underwrite them, simulate them down here. So you pull a couple of properties here, you drop them in. That's what I'm going to show you today. Because the property we're going to do today was pulled off of Crexy. It's a 33 unit in Phoenix, Arizona. I underwrote it this morning. I'm going to show you. And then from there, you're going to do the exact same thing on any stuff in your areas. And I don't care if you're going to do the deal or not. It's completely irrelevant. I need to get you into the process of simulating, doing the research, going through those data sites that are in your portal and logging into them, getting your account set up and start looking and looking at the research, jobs, population growth, understanding good markets and bad markets, stuff like that. You got to go through those websites that are in the portal on the data and research stuff. Okay. Next, you're actually going to set up a couple tours of these properties with the commercial brokers just to tour them. You're not going to buy them. You may or may not even make an offer on them. But I want you to tour them, and I want you to shake their hand and look them in the eye, and I want you to hand them a business card so they know you're interested in the market, you're a player. So that way, the next time it comes around and it does become real, now they've met you. Now you actually have a connection, because what's going to happen is you're going to take all this stuff here that's all on market opportunities. And now by creating the broker relationships, now you're going to start to see off market opportunities, because now they know you. You're going to be on their email chain. You can say, hey, John, broker with Marcus and Millichat, I'm looking for this. Can you send me your first look kind of off market deals before they go on the market? And that's how you start getting the flow coming in for on and off market properties. You got to start in this area. So you're going to tour properties so you can make the relationships, shake the hand, belly to belly, create the relationship bank accounts, stuff like that. And then you're going to write some fake offers that you have no intention of them getting accepted, simply to pass it across the table. And we have the template. If you go into the downloads, you have a letter of intent, an LOI. You're going to see the formats in Word document You're going to fill it out, right? And we can go over those. I'll actually go over a letter of intent next week if you want, on how you would write it up and how you would submit it. That way, that would be an offer on a property, on a commercial asset. And that'll be very, very helpful. And you're going to submit those offers, and that's not legally binding, so it doesn't matter. Even if they wanted to accept it, you could say, oops, sorry, I don't really want it anymore, right? But just understanding the process, okay? So that way you can simulate it. And then the last part is we need to set up your systems. I mean, we've talked about this from getting your LLC, your holding account, or your holding company set up, okay? As well as a simple website that talks about you and your company and you and what you're doing as an investor now, right? I mean, you could be, Dawn, for example, you're working with the utility companies. Well, but now you're a real estate investor and a utility guy. So set up your website, look the part, be the part. We got to set up your systems. So a basic website, set up your company, all that's in the portal. And if you go through it on how to set up your admin and your back end, we're going to get all that set up for you. That way you kind of look and feel the part, because that's how you're going to attract people and attract investors. So that's why we want to get that underway as setting up the systems. So this is really your first 90 days on how you're going to start seeing deal flow, start simulating things, networking, going through the coursework and setting up your systems. So that way deals can start moving your way and you can begin to execute. So let's jump into the property. We're going to underwrite this, and I'll pull it up on the screen here in just a minute. How are we doing on time? Okay, perfect. This will be good. About 20 minutes this, and we'll be good. So this is a 33-unit deal, single-level properties, all 2-bedroom, 1-baths. A certain number have already been renovated. A certain number have not, okay? So I'm going to scroll through. We don't need to get through all this, but this is an operating memorandum. So when you go to, say, Crexy, perfect example, if you go to Crexy.com, you sign up, you're going to get some emails flowing through. It'll say, click on this. When it comes in your email, it's going to load to what they call the deal room. You'll have to sign a quick little confidentiality agreement, all digitally. Then you get to download the package of documents. And it's going to be an OM, which is basically the marketing package for the property. You're going to get the T12, which is the profit and loss statement for the last 12 months. You're going to get a rent roll, which shows you everybody that lives in the property and the rents they're paying. And you may get a few other pieces of the puzzle, okay? But from the OM, you can do a lot. So it's just giving you a lot of marketing materials on the property. This is just showing you kind of, generally speaking, some details about it. They're actually putting down an asking price. A lot of times they don't. But in this case, asking price, they're saying, hey, here's a scenario. If you put down 30%, 27%, here's what you're buying on a price per unit. They mentioned things like T6. So that means the profit and loss for 6 months. That's what that means. But it's showing you what your cash on cash returns projected will be, cap rates, post renovation cap rate, and then cash on cash returns, right? Keep in mind, and I'll say this is all bullshit. It's the broker marketing the property. They're not going to show you the worst case. They're going to show you the best possible case under their thought, okay? So, but you take it with a grain of salt. You look at it, you say, oh, that's great. But you got to move through this stuff. They're also showing you the financing. The cool thing about this property is that you can either get a new loan on it, or they do have an assumable loan that you can assume under these terms. And I'll show you how we underwrote it both ways. And I'm going to show you what the results look like. So that way you could, without getting a new loan on the property, which is this option, you can assume the existing debt on the property, which is sometimes easier, and take that on. So it's actually pretty cool. This is just showing you the current of the renovated units, okay? They're saying it costs about $15,000 a unit to renovate. Probably about right for Arizona. It's probably about right. They're saying they're getting $200 on average from a classic unit. So when they say classic, that means original, non-renovated, non-touched. Renovated unit, and then you have partial renos. Maybe there's some reno done. So you kind of have 3 categories usually. You got classic, partial, full reno. Okay. But they're saying 19 units have been renovated basically. And then they have 3 that have connections. So all in all, I think they got 22 is what they're saying. We'll leave it at that. And then the rest, 11, right, are non-renovated classics. But then they just give you some photos of the property. kind of showing you some fluff. They're showing you, this is kind of cool. They show you the before and afters. Okay. So this is they're giving you a value add proposition. And they're saying, hey, if you reno, average cost about 15 grand, that's probably not too far off. Your premiums projected around $200 bump. So if it's a $1,200 now, $1,400 after, okay? And kind of return, well, it's supposed to, this should be what they call ROC. They say ROI, return on cost. This is what, a key point. This says 16%. You can see that. Ideally, a baseline would be 18 or more in terms of return on cost. You put X dollars in, how much more rent do you get? That ratio, I can show you in the pro formas, how that gets calculated, okay? But you get to see kind of the currents, right? Older looking white appliances, you know, they're updating here, blah, blah, blah. And then they're coming in and all they're doing is refacing the cabinets. They're painting everything, refacing with new cabinet doors and hardware, putting Formica tops on them, stainless steel appliances, new LVP flooring. Ta-da! So nothing too crazy. We do this stuff all day long. So they're just kind of showing you kind of the renovated units. Your typical kind of flip, agreeable gray paint, Formica tops, refaced cabinets, LVP in the flooring, stainless steel appliances. Very, very simple. They resurfaced the tower shub combos. Yep. All pretty standard. And then they're going to give you some financials and projections and stuff like this. And this is the information you're going to use initially that you're going to input into the pro forma that you get to download. I'm going to show you using the pro forma that you download what it looks like. So I took these financials and I plugged away at them. And I just took their numbers, basically. I took just to give you an idea, we'll take a look at this because this is kind of where you're going to start, what they call the unit mix. Okay? Unit mix. It's showing you the types of units, how many of them there are, the square footages, what they're getting per month on rent now, right? So they're showing you current. And then they're showing you projections. Pretty much just like the pro forma, current projections, which is great. So they're saying, hey, you can go from, if you take a non-renovated unit that's classic, renovate it, it's currently getting $1,350 in rent. We can get $1,550, $200 bump. If you take the partial renos that already have some renovations done to them, the ones in there, the 22 or whatever, do a little bit more to them, you'll pop those up to $1,550. So that way you're going to go from about $560,000 a year in total potential income to $613,000. And you'll be able to see how that movement works in terms of valuation and cash flow. And I'll show you that in just a minute. So that goes through all this, and then you just got a lot of fluff. You know, they're showing you, hey, what are other properties in the area selling for? What are the comparable rents? I think that's right here. They're showing you the rental market, right? Comparable rental properties, right? And when you go tour these, let's say you flew out and you wanted to go tour the property, you're going to tour all of these. Like you're literally going to drive to them, walk them, touch them, feel them, see who your real competition is. You need to know that. So that's why that's here. And see if it's a real comp or is it bullshit, right? Is it real or bullshit? And that's why you do that. But that's part of the touring process. And then it is give you a bunch of other fluff. So for now, so you kind of see this. That's the OM. You can see how I took, we're going to take just their data that they gave us for simplicity today. Okay, so this is their income and expense projections. And this is the unit mix. Okay. So we're going to take this and we're going to take their financials. This is a profit and loss statement. This is current. This is future. Okay. And we're going to plug that into the pro forma right now. So let's walk through this pro forma. As you can recall, I put in the price of $7 million up here. Now we're going to run scenario number 1, meaning we're going to get a new loan on the property. So I'm going to come in with a down payment of 30%. It's automatically putting my loan in here for me. We have 33 units. Based on that purchase price, it's $212,000 a unit. I'm going to put in a repair budget. If you remember, they said it was $15,000 a unit is what they're projecting. So I said, okay. So for the 12 remaining units, it'll be $15,000. For the other 22 units or whatever, maybe it's like $5,000 to $7,000. So let's just put in a number there of $250,000, which kind of averages out. I put in the age of the building, the lot square footage, because that's all on the OM, the operating memorandum. Closing costs, I'm going to use 1% here. It's going to be probably between 1 to 2%, just FYI. But we'll use 1% for simple math here. And then we're going to put in the loan terms. So right now, you can get a loan in the marketplace, fixed loan, probably a 7 or 10 year loan for somewhere around 5.75%. Maybe it's 6, but somewhere right in there. 70% loan to value. So your loan amount's that, interest rate's that. It's a 30-year AM and 30-year amortization, meaning they're going to amortize the payments over a 30-year window. Okay. And then here is the payment amount. So this is payment based on principal and interest. This is payment based on interest only. We're going to go ahead and use the principal and interest just for simple math, but you may get lucky enough and maybe your loan gives you a period of the first 2 years of the 7-year loan is interest only. So that's going to help out your cash flows, which is awesome. But in this case, we'll presume, in this case, it's all principal and interest, okay, just to see how the math works out. Now we're going to plug in the units. You remember the unit mix that I was showing you on the screen? Awesome. So now we have all 2-bedroom, 1 bath based on the operating memorandum they gave me. I'm putting in the unit mix here. So 12 units and 21 units gives me the 33. The current rents per the operating memorandum is $1,350 for about 12 of the units and $1,450 for about 21 of the units. So I'm plugging that in. It's giving me my total monthly income. This is already hard-coded. Remember, on the pro forma, everything that's in blue, you can plug and play with. Everything not is all blacked out, basically, in formulas. Because you can see the formula up here. Right? If you click up in the bar, it gives you the formula. But anyhow, so that's your monthly rent of $46,000 a month. Okay? And then you come over to the pro forma rents. You got to put in your square footages of the units. That gives it to you on the operating memorandum on that unit mix. So now our new projected rents are $1,550, remember? And now we're going to be upwards of $51,000 a month in total potential income. Now we need to put in our operating expenses, plugging in the taxes they give me, and plugging in the insurance numbers they give me, maintenance and repairs that they give me. I mean, they're basically handing me at least their projections. So I'm going to use their numbers just to see if this thing works or not. Okay. So this is the simulation game I was talking about. So I'm literally plugging in all the numbers as they give them to me into the pro forma. So I have total expenses down here. It's giving me an expense ratio. So that's what this is. When it says percentage of EGI, what that means is it's this 154,000 is 27% of my effective gross income. So you can see the formula, and I'll show you down here. So anytime you want to see what the formula is, you click on the cell, and then you can actually come up here to the formula bar up top here. Click on that, and it's going to highlight everything that actually corresponds to that. If you want to learn kind of the Excel thing a little bit on basics. And then you just press enter. But that's giving you the sum there, and then you have your percentage. And if I click on the bar up top, see how it's highlighting it? It's showing you the 154,000 is 27% of the 569,000. It's an expense ratio. So the reason we use that is it's kind of like a little metric to kind of see where that's at. And that's, it's a little low, but not really. These smaller properties can operate like that because they don't have as much payroll and some other expenses. And it's really relative to the taxes and insurance, because taxes and insurance and payroll are typically your biggest expenses on any property. So we're plugging in all their numbers. We're getting that. It's all putting in the metrics. And then down here, now you get to see current versus the projections. So we're saying, okay, total projected income, current versus pro forma. Then we're taking out some credit loss. They call it economic loss. This is all given to you on the operating memorandum under that profit and loss statement. You're adding in other income, which they actually give you that total. It's called RUBS, and I'm going to show you here in just a second. So if you actually went on here, let me show you where this stuff's at. Do you see how this total potential income, that's on the pro forma I plugged in here? Then I'm going to total all these guys up. That's going to give me the 49. Okay, that gives me the 49. Now you can use it, you can put it in a percentage because it formulates it by percentage on the pro forma to essentially equate that number anyway. So just mess with the percentage number until you get to their total, okay? And then the other income is right here. So I totaled that up and I plugged it into the pro forma. And same thing on the post projection side. And then you see all their expense numbers, right? So I literally plugged them in almost exact for exact. And then it's going to populate some stuff. So you see how they have this EGI down here, right? And then net operating income. The same thing down here. As we're coming in here, we're plugging in the numbers. That's giving us that automatically. See how I'm changing these percentages just to get close to that number. So if I had it at 8, see how it would change that. 7 changes that, right? 8.5 or whatever. 8.8. There, let's keep it at that. I added in the other income here, and now it's totaling things up here for me. See how the expenses, now it's taking out the expenses. So it's bringing these numbers down right here, and then giving me my net operating income of 416 and 485. So 416 current, 485 for the future. Now I need to take out my debt, which is my mortgage payment, right? And I'm going to use the principal and interest up here. It's bringing it down. See this number up here? It's automatically already formulated for you down here. Taking it out to show you your free cash flow. And this is current versus projected. Now, unlike in the past, and this is what I recommend, and I'll show you why. In the past, you could buy properties that maybe don't cash flow today, and you would build in an interest reserve because you were going to renovate them, value add the properties to get to a cash flow positive later. I wouldn't recommend doing any of that now. That was kind of like past tense. We're in a new market. The property has to cash flow correctly today, not tomorrow, not 3 years from now. It needs to cash flow today, so that way everything upside is upside. But you can't bank on that anymore. You need to hope for that, but you need to be able to operate it today. And the bank's going to force you to do that. They're not going to give you a loan on something that does not cash flow today based on certain metrics. And let me show you what those metrics are. So the bank is going to look at a couple things. See this thing here called DCR? That's called debt coverage ratio. If you look under your glossary of terms that's in your downloads, it goes into what debt coverage ratio is. The bank wants to see a debt coverage ratio north of 1.25 minimum. So they want to see that you have at least 25% more free cash flow to pay your mortgage every month. That way you have a buffer, in case you know what happens. So they want 25% more. Well, right now, based on these projections, this thing doesn't do that. It doesn't do that. So the only way I can get it to do that is a couple things. Either interest rates change and I get a better interest rate, so my payment's lower. So let's say I was able to get a 5% interest rate. Watch what happens now. Now my debt coverage ratio is 1.32. We're rocking and rolling. Well, as we all know, interest rates are much higher now, so that party's over. So 5.75, that's where the market's at today. Okay. Well, maybe I can put more money down. Maybe I change this from 30% to 40% down. Okay. Now that's more equity but less mortgage. Now my debt coverage ratio is 1.42. But does it make more sense to put more money down? Because you still got to cash flow the thing. See how the metrics are coming down here, the cash flow? So I don't know that I would do that because now my cash on cash return is only 3.92%. So I don't know if that makes too much sense. So let's keep it at 30%. Well, then you're like, crap. I can't, under this scenario, it doesn't make sense and the cash flow is too low. So I can't pay their $7 million anymore. You see how I'm kind of working my way backwards? I'm basically fitting this thing to work. You're either gonna, if you can't change some variables like interest rates, or if I change the down payment, it doesn't make sense cash flow wise. Well, then the only other thing that moves, if you can't increase the revenue, the only other way is I could come in here, I could say, okay, well, I'll put 30% down. I'll pay them their $7 million. I can do the 5.75% interest rate, but that's only if rents are $1,600, not $1,550. Let's see what that does. So now we got more revenue. The expenses are what they are, give or take. So now, but that still doesn't work. I mean, maybe my current rents can go higher. Maybe it's $1,400 and $1,500 under current rents without doing anything else. The market rents have to change. See how that works? Now it's 1.26. So that does work. But you have to then verify, could I actually get those rents? Or is that all pie in the sky? I wouldn't bank on that rent thing. So I'd keep the rents the same personally on this type of deal. I'd come in and I'd say, hey, I can only offer them $6.5 million. I can't pay their full asking price. So watch what this does. $6.5 million with 30% down, same interest rate. Now my debt service drops. My rents are exactly the same. My expenses are exactly the same. The only thing that changed is price. There we go. And now look at my cash flows. They're over 4%. I got a cap rate over 6. Not bad. Now that's current. Keep in mind, that's current. Now, if we hit our future projections, look what happens to your cash on cash. It goes to 7.4% almost. You have an average cash on cash return of over 9% a year when you actually start taking in time into consideration. I'll show you that. And now you're going to build into an 8.75 cap. That's fabulous. Now your equity multiple, and I'll go into these little metrics. Your equity multiple is 2.52. What that means is that if I give you $100,000, I'm going to get $252,000 back on the deal. It's, over the course of the hold. 2.52 times on my money. For that number to be worth it, you want over 2%, over 2 times. So you want the equity multiple needs to be over 2 in order to do a deal. I would want to see cash on cash returns kind of like where they're at, 7 to 9%. That's kind of where that thing should shake out. And you see that IRR number right here? That's pretty darn good. I mean, if I can get internal rates of return north of 15%, 15, 18, 20%, very good. Okay. So that's on this thing. And then we go to the IRR, which is the, what I'm doing is I'm taking these financials. Now I'm going to add time to them. So we're here in 2023. Let me zoom up on this. We're here in 2023. That's the static numbers. Debt service, NOI, the same thing that's over here. See? NOI, debt service, free cash flow. We're taking it over here into our first year. And now what we're going to do is add time to it. And when we add time to it, we can also add rent bumps, meaning increasing rents. So when we do that, now you're adding time and increasing rents. So then when you look at your valuations, I mean, these are wrong at the moment, obviously. It's saying that, but obviously you're not buying it at that, but that's great. But by the time you sell this thing 5 years from now, projected valuation of 9.4 million. You're buying it for 6.5, selling it for 9.4 at a 6 cap. You have all these increasing rents over time, appreciation due to cap rates and increased rents and net operating income. Because your operating income is starting at $485,000, you're ending at $568,000. Okay. And then you have your debt service, which is fixed. Free cash flow is increasing. See how your cash on cash return, which starts at 7.4%, ends up at 11. That's how you get this average of 9.17. That's pretty darn good. And then you're going to sell the property for 9.4, 9.5 million. You're going to take out closing costs and sales costs and everything. You're going to pay off your mortgage. And then you get to your total proceeds. So now you're adding in total proceeds and all your cash flow. You're going to take out your initial investment into the deal. Gives you your total profit. Hence the reason you get your annual rate of return of about 24% on your money. Would you like to get 24% on your dollar? Yeah. All day long. And twice on Sundays. So that's how this deal works. So this deal works if you can buy it at 6.5 million under the current interest rate environment. Now I'm going to show you really quickly by changing the numbers what it looks like if you assume the existing debt. So this was based on if you get new debt on it. But what if we assume the existing debt, right? Now the existing debt, you can only get so much. So if you remember what they're telling you, if I take on the existing loan on the property, this is what it looks like. The existing loan's 3.3 million. The existing loan is at 3.71% interest rate. Yeah. So, and debt coverage ratio currently 2.66. So let's plug that number in. Let me just show you real quick what that looks like. I'm going to come in here into my debt area. I'm going to change this to 3.71. Now I need to change the loan amount because obviously I'm not getting 4.5 million now. Now I'm going to be getting 3.364. So I need to change this to where we have more money down. Maybe it's 50% down. Maybe we do 52. Oh, sorry. Let's do 49. What I'm trying to do by changing this is I'm trying to get this number here close to that 3.364. So maybe it's 48. Okay, we'll keep it at that. So loan amount of 3.38, that's close to that 3.364 amount that is existing. 3.71 rate. Here's my debt service, which matches what they have. Now let's see how the numbers look at 6.5 million bucks purchase price. The point I'm doing this for is, does it make sense to assume the existing loan or does it make sense to put new debt on it? You see what I mean? Does it make sense to assume the existing debt or put a new loan on it? And what I'm looking for is my returns down here. So if you can come up with 3.12 million, actually with the closing costs and everything, you're going to come up with 3.4 million in cash. If you can do that between you and investors, now keep in mind, total equity is 3.4. You only need to come up with 10% of that as a general partner, so 340,000. Now, you don't even need to come up with that. Maybe you only come up with 5% of that, which is half that, 150,000 in cash, and you raise the rest from investors. Now, you may be saying to yourself, oh my gosh, I can't raise 3 point whatever million. You'd be surprised. Trust me, you'd be very surprised. I think you'd be very surprised that you could raise that. Because under these terms, the cash on cash return is pretty darn good. It's much higher. Now, the projected ones aren't much better than if we put new debt on it. You see that? And your equity multiple isn't much better either. Pretty much similar. And your IRR is actually less. So based on all this data, it actually makes sense to put 30% down, so less money in. So now your total equity drops over $1 million. Okay. Your interest rate, I can pay a higher interest rate because now my future projected returns are still pretty good, almost identical, but I'm having less money in the deal. I'm having to raise less money from investors and everybody. And my annual rates of return and my equity multiples are higher. So you see how that works when you kind of play with the scenario to see which one is best. Okay. So under this scenario, this is what I would do under this deal. Buy it somewhere between 6 to 6.5 million, put new debt on it at 5.75%, 30% down. That means we have to bring in about $2.3 million in total equity, of which as a general partnership, we have to bring in 230,000. I'm going to raise the rest from investors. And those investors are going to get an 8% preferred return, because the cash on cash is pretty good. 8% preferred return, plus they're going to get 70% of the deal. I'm going to keep 30% of the deal. Our 230,000 gets to get invested right alongside the other investors. So we also get the 8% preferred return. Plus we get 70% of the free cash flow and profits. Plus as a general partnership, we get what they call the promote. So that 70-30 split I was talking about, and I know this gets a little complicated, but let me break this down for you. Because I want to see how I want to show you how you would structure this deal with investors. You can actually see how this would work. Okay. So based on these numbers, if we bought it for $6.5 million, we're going to get I think it was a $4.5 million loan. Let's just keep simple math. Okay. And with closing costs and everything, you add everything in, blah, 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 we have to come up with 2.265 in equity. Here's our loan. Here's our equity. And that totals that, including closing costs, rehab money, all that stuff. Okay. So of this equity, this is how it's going to split down. 10% GP, 90% limited partner. So general partner, limited partner. This is basically all the investors. This is you. So you're going to bring in, call it 2.3. I'm sorry, 230,000. But freak you out. You're going to bring in 230,000. The rest is going to come from them. So I don't know what that works out to. I'm a little brain dead this morning. But 1.8 or 1.9, is that what it is? So 2, 3. Yeah, I had it right. Let's call it for flat numbers, $2 million. Okay. Now, for this, you're going to get 30% of the deal as a promote, like an extra profit for putting the deal together. Okay. And your 230K, you're actually going to invest it alongside the limited partners. So they get 70% of the deal and an 8% preferred return. What I mean by preferred return is that gets paid or accrues if you can't pay it, accrues or gets paid first before you split any profits 70-30. Okay, so this gets paid or accrued, gets paid out to the investors first before you split 70-30. Your 230K gets this as well, and you get this. So you get 70% of the deal, and you get 8% on your 230, and you get 30% of the deal as a general partner. That's why you put these things together. Okay, it's a benefit. You're putting in time, energy, everything you're doing to make everybody money. You need to get paid handsomely too. But if you're making everybody money and good money, you should be paid in relationship to making everybody money. That's why this gets done. So you're going to raise the $2 million from investors. They're going to get 70%, 8% of the deal, and based on the returns, they're going to get about 2.5 times on their money, right? So if somebody comes in and gives you 100 grand, they're going to get 252K back on their investment. And they're going to make probably about 20% a year on their money based on the numbers we ran. The numbers on the sheet were about 23, 24%. But when you actually break it down on the splits, they're going to make somewhere right around that. It'll probably be 19 to 20% on their money a year. I mean, yeah, all day long. I mean, if you told me, if I give you 100 grand and we buy this 33 unit, that I'm going to make about 19 to 20% on my money a year. It's going to free cash flow. It's going to have fixed rate debt on it. And we get the appreciation, and this is not even calculating the tax benefits through accelerated depreciation and cost segregation. Because I can guarantee you that out of this equity that you're going to bring in and this price you're going to pay, I can be willing to bet you that if somebody gives me $100,000, I'm going to probably be able to give them a negative $90,000 loss year one on a K-1 statement that they get to give to their CPA to write off against their income. Tax savings. You don't get to pay Uncle Sam. You get to keep the money for yourself. $90,000 worth of it. So would you rather give Uncle Sam 90 grand because of your income taxes? Or would you rather keep the $90,000 for yourself and make yourself richer? Tax benefits, tax benefits. You don't understand. Like, that's the holy grail of owning real estate, especially commercial real estate, is the tax savings. Think about it. If I were a doctor or anybody else in a real estate professional field, and I had capital gains, because there's ordinary income and there's capital gains. So that's why it's so critical that if you're in a profession that's not real estate related and you get a W-2 income, okay, from an employer, if you want the holy grail, this is why you need to own these properties and then manage some of them. So now you can classify yourself as, someone working for the utility company, okay? But I'm also a real estate professional. You're a CPA. We'll be able to categorize you if you spend a certain amount of hours doing this. Now you're a real estate professional and you're a utility guy, or I'm a doctor and a real estate professional. So that way I get to write off this $90,000 savings, gets written off against capital gains taxes, but also against my doctor income. When you start to see guys, I haven't paid income tax in 7 years. I have not paid income tax in over 7 years because of this. That's the whole, with all due respect, screw the cash flow. I haven't paid income taxes in over 7 years. And you could do the same. Even if you just got that. But obviously you're getting the holy grail of the returns, okay? So you get all this, plus you get all that. When you actually add it all together, it's a lot. This is how it all gets done. This is how the wealthy become super wealthy. This is how you have to save. Stop paying Uncle Sam by investing in real estate correctly, using cost segregation, accelerated depreciation, getting the tax benefits, and you do this every year, right? You stop paying the federal government, you pay yourself. And the reason why the government allows this to happen is because the capitalistic system was always designed to benefit people who take risk into the U.S. economy. If you take a lot of risk into the U.S. economy, the U.S. economy says, hey, thank you. You basically don't have to pay us anymore. That's basically what it's doing. And they give you a lot of loopholes and design things to allow that to happen if you take risk. If you create jobs and you put money into the system, we give you lots of benefits for it. If you're a W-2 employee and you're just working in a cubicle, we don't give you a lot of benefits. You're going to pay us and you're going to be a slave to the system. That's designed to do that. But if you take risk and you're an entrepreneur and you're going to go out and you're going to make things happen, create jobs, create money, create flow, create all the stuff, ding, 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 we're going to give you the holy grail. That's capitalism. That's how that works. And if you don't like that, I don't know, go to Sweden. But that's how this works. And if you understand the benefits of it, you can do very, very well. So I hope this makes sense, but that's how I would structure this deal. You're coming in with 230, you're raising 2 million. They're going to get this as a benefit. You're going to get that as a benefit. Plus you get this as a benefit and they get the tax incentives. So when they actually see all of this, I can guarantee you raising this 2 million on this deal, easy. When you put it together in a nice pitch deck, which you have a template for, you could raise this all day long. And to get the debt, to get this $4.5 million debt, I mean, all you're going to have to show, just so you know, and this is presuming you're the one signing on the loan only, and you don't have another partner in there. So you will have to show a liquidity of $45,000 in your bank account, and you will have to have a net worth of $4.5 million. So then the next question is, well, I don't have a net worth of $4.5 million. Okay, great. So then you need somebody to co-sign with you to become a partner in this side of it. Up here is a GP. And then you can get this. And that's how you'll get the loan. So they want to see you have 1-to-1 on net worth and 1% liquidity against the loan. They're still going to underwrite the property in terms of paying them, but they at least want to make sure that the borrower has some financial stability. And that's why they look at that. 1% of liquidity on the loan amount and 1-to-1 on net worth. And that's how they'll typically do that. So yeah, I know that was a lot. The good news is this is recorded and you can watch this over and over and over again. But I hope this was super helpful. What if I didn't have 230? What if I only had 100? What if I only had 50 or 200? That's okay. That's okay. Depending on the deal, that just means maybe you'll need to give more away. Maybe this ends up being a 25, writing out 75. Okay. I mean, it doesn't always have to be 10%, or what you do, maybe you only have 100, but maybe you can go grab a friend that has another 100, or maybe you can go grab somebody that's going to be putting money in here in the 2 million and say, hey, I want to bring you into the general partnership with me. We're going to bring your 100,000 in or 150,000 in. So we have the money. Now you're co-GP with me and we go do the deal. And now you're bringing them into the GP side. And remember, the benefit of the GP is that you get this 30%, plus you get this 70%, plus you get this 8%, plus you get all the tax benefits for putting the deal together. You get to double dip. That's the beauty of being a general partner and taking on risk, because you're signing on the loans, you're doing all the management, you're putting in all this time and energy, right? Now you may be saying to yourself, well, do I get paid any fees on top of that for putting the deal together? Yes. On a small deal like this, it wouldn't be as much, right? But to give you perspective of what it could be, so on a $6.5 million deal, you wouldn't do it on this one because you don't have the margins. But normally you get paid a 3% acquisition fee, a 1 to 2% asset management fee, and a 1% disposition fee. What does that mean? 3% on $6.5 million is what, 180,000? Is that right? Give or take. Right, 195,000. You build this into your closing cost. Now, on this deal, you wouldn't do that because it's really going to hurt your numbers. You'd probably bring this down to a 1 to 2%, maybe, or 1.5%, right? But you get paid a fee for your time for putting it all together. And that gets paid at close of escrow. No different than a commission check to a realtor. Same thing. Asset management. If you're generating $100,000 a year, hypothetically for a minute, okay, you're going to get paid 2% on this. So, I mean, it could be, let's call it $2K a year. I mean, it's not a lot. It's just designed to kind of offset for a time of management, right? But $2,000 a year for helping, manage this income stream. And then the disposition fee. So you go sell that thing for $9.4 million down the road. Okay. As part of that, you get your closing costs, right? Then you're going to get your disposition fee of $94,000 to use the general partner. Okay. You get that, you get that, you get that. Plus you get your 8% on your money, plus the 70% on the cash flow, plus the 30% general partnership, plus the tax returns. You see where I'm going with this? So people say, how do you make money in this? La la. Sorry, but that's how it all works. So what do you do to get prepared? Like I was saying, really for the first 90 days, this is where your time should be spent right now. If you got signed up here, great. Make sure you go through all the coursework. Awesome. I would be underwriting deals. I would be going through because if you've already done a lot of this stuff, I'd be setting up for the networking and I'd be simulating deals. By signing up here, getting deal flow and simulating this research. Do you understand the pro formas? You understand all the downloads that are in the system? That is the preparation and the homework every week to really get comfortable with all of those downloads and simulating the processes of looking at deals, underwriting deals, playing with the deals, writing up letters of intent, stimulating the process. That is really where your time is best spent in preparation for all of this that we do every week. And then you can bring stuff to the table, because let's say next week you looked at a deal from Crexy, you underwrote it, we would chime in, I'd bring you on screen, and we will underwrite it together, or we will look at your underwriting and critique it, right? But then make it better and learn live in real time. So Colleen, can I actually bring you on screen real quick before we finish up? So ask a couple quick questions. I know we're going a little bit over time here, but did it make sense on kind of the homework and stuff to do in preparation moving forward?
Absolutely. I'm ready to go. I did all the courses, so I wasn't sure if I was missing something that you've talked about previously with your other people, but yeah, I just need to dive in deep, do all my things that you just said, and then come to the party next Thursday with any questions. So all good.
And then in terms of the analysis today, I know it was a lot. Was it like way over the head, or did some stuff connect for you? Because it is a lot, and it's going to seem very foreign at first.
It was a lot.
Information, numbers, I get it. But as we do more and more of this, it'll begin to connect more and more and more, and you'll start linking and seeing all the dots.
Yeah, I think I just need more time
to
not be. I'm not overwhelmed. It's just a lot of new information. But once I pick it all apart, I think it's not basic, but if you just enter it in the system, that's it.
Yeah, correct. Yeah, and using that simple pro forma, that's why we start you off with that one. Because you can see we used it on a 33 unit. And your first deals are probably going to be I would love your first deals to be somewhere between 6 to 30 units. And be in the commercial space, I call it. And not in a duplex, triplex, or fourplex. Mainly for the financing side of it. It's going to be easier for you to get a loan on a commercial property.
Okay.
Simply because they're underwriting the property, not you.
Mm-hmm.
That's the main difference.
Mm-hmm.
They're not saying, hey, Colleen, give me your financials. Hey, give me your tax returns. Hey, give me your bank statements. Hey, give me all your stuff. They're saying, give me the property's information. We're going to underwrite the property. You'll show us a financial statement. That's just, whatever. And that's it. And then they're going to underwrite the property, and they'll make sure that your liquidity is at least, 1%, like I'd mentioned, and you have a net worth equal to the loan amount. And if you don't have either of those, then you just bring in a co-general partner to help out with that. And that's how that gets done.
Yeah.
And then structuring the rest of it, we can help you with. That's why we're here.
Mm-hmm.
So that's why once you actually get a real deal, and if you have questions on the structure, just like I showed you, I'll show you again. This is how you structure the deal. We have legal document samples, all the downloads for you. Mm-hmm. And we have all the templates there for you. So that way you can structure it legally, the legal documents with the partners. You have pitch decks to present it to them. You have letters of intent to make an offer. You have the pro formas to underwrite a deal. So all of it's there. It's just making sure you take some time to go through it, learn it, reprocess it, go through it, reprocess over and over again. In the first 90 days, and we'll put this in a guide, but yeah, getting here and looking at deals and just getting comfortable with looking at the deals. Looking at the operating memorandums, the OMs, looking at the profit and loss statements they give you, looking at the rent rolls, and just getting comfortable in your brain of what that looks like. Step one, going through all the coursework, what you're doing. I would set up to go to 2 networking events a month to start. Maybe they're meetups in your local market, because I know you're in Texas. If you're in California, there's plenty of meetups. Go on meetup.com, plenty of them. And go to just a couple of them to start. Even if you sit in the back of the room and do nothing but watch. just do that for the first couple, and then you get to meet people. You'll be amazed what starts to happen. You'll have different levels of investors, different levels of people. Some people have money, some people don't. Some people are here, some people are there. But you make those connections and you'd be surprised. The networking's key. And then we'll get into the conferences and stuff, which we're putting up for you guys to go to. And we'll keep adding to that because there's new ones all the time. And then beginning to simulate the deals. And that's what we talked about. Underwriting and using the pro formas, using the download on all the data sites to get signed up for them. Most of them are free, to start learning how you do research in your market, right? For rents, for population growth, for job growth, all these things that you kind of need to look at before you're verifying a deal. And then touring properties, even if you're fake touring, like we talked about. Simply to go there. Hey, John, you're the broker from, Marcus and Millichap. Great. You're, running this property. Awesome. My name's Colleen. We're touring it. And that's it. And then you hand a business card, and now you got the eyeballs going. And then in that conversation towards the end, you're saying, hey, John, whether this deal works, I'll underwrite it and look at it further, but I'm looking for properties like this. So if there are 10, 20 units, 15 units, 5 units, kind of like this in this marketplace, if you have anything before it goes to the market, here's my email. Let me get on your first look database. Because that way they'll start sending you before it goes on to this site or the other ones. And that's what you want. You want it coming in from multiple angles.
Super.
Yep. And then writing fake offers, which, it happens all the time. So.
Okay.
Awesome.
All right. Have my homework.
Yeah. Good to see you.
Thank you. See you next Thursday.
Yeah. Awesome, everybody. So that is what we have for now for today. This is all recorded. It'll go down and be uploaded into the playlist for you. And that's in the top of the coursework. You can go back and replay these as you wish, fast forward, slow down, anything you want to go through all this stuff again. And we'll get all more stuff uploaded for you. And remember, throughout the week, if you need to text or email with specifics, we're here for you. Okay.